It's about lessons learned here on Wall Street Confidential, and a guy that's been certainly around Wall Street for many, many decades. Jim Cramer, welcome. I want to talk to you about the Federal Reserve and the psychology that the Fed instills in the market, inevitably, you say.
Yeah, I mean, one of the things that I've spent a lot of time thinking about is not necessarily the fundamentals of companies, although I certainly want to know them. It's how they will be interpreted in the stock market. I mean, a lot of people are trying, particularly in the conventional media, trying to pin me down to what I regard as being whether I'll be right in the next 48 hours, the next 2 weeks. And one of the things that I've tried to do is impart the lessons, the mistakes that I've made with the idea that the next people won't. In 1998, the fundamentals before the Fed's emergency meeting, the fundamentals after the federal emergency meeting were unchanged. But why did stocks go up dramatically? Why was that the last great buying opportunity where you made 6,000 points? And the answer is that the same pieces of data that were being reported before the Fed action were then subsequently viewed quite differently after the Fed action. And what I'm urging people to do is understand the psychology and not to fight it.
So the rate cut essentially not only allows for more liquidity and this
credit crunch. Take that off the table.
Take that off the table. It's the psychology.
No, I mean, because there's probably less liquidity now than there was, 5 days. There's people coming in from the sidelines, but every day there's new subprime problems. What I'm saying is I'm stipulating. I am seeding the notion that things aren't better.
Let's take yesterday as an example. We saw retail stocks like the Lowe's, Saks, Target got an upgrade, and the average investor looks at that and says, well, their earnings were great. There were some upgrades. But
they weren't.
Yeah,
I mean, a lot of people see a stock price and therefore say that the quarter must be good. By the way, Saks' quarter was not that good. There was no gross margin improvement, and that wasn't. Saks is now annualizing some really hard compares. So that stock goes from being a strong buy in my book to being a hold. It's a new posture for me. I've liked the stock for a couple of years. Lowe's Corp had nothing good to say. I mean, they did mention that we're going to annualize easy comparisons. A lot of that is because lumber costs have come down. And some of that is also because the Northeast had better weather than last year. But if you go and follow Niblock's comments straight through, and I happen to have met Niblock on this during this period, you'll see that things had pretty much of a downtick. And then you say, okay, well, how could a stock go from 26 to 29? And the answer is that the Fed has changed the psychology, and their downtick, which is basically what they predicted, is now considered to be better. With the notion that there could be someone to rescue Lowe's. Retail has been a fabulous place to be once the Fed stops raising and starts cutting. And I feel like that what people have to recognize is that they need to think about that prism. They can't just look at the company. If you just look at the company, you'd be shorting Lowe's. If you just looked at the company in Dick's, you wouldn't have moved it up 6 points. The Dick's quarter was quite good, 8 cents better. So what I'm emphasizing is use the lesson that I've learned, which is that don't be so granular. Don't look at Lowe's Corp and puzzle over why Lowe's is going up. Look at Lowe's Corp and understand that we flipped in the way we look at things. And Lowe's, Toll Brothers, these are now situations that have stabilized to going down that could get better. And do not outthink this, because there is no way, if you read, it's almost better, and I hate to ever say this to people because it sounds so unrigorous, but if you didn't read the Lowe's conference call, you would do better than if you read it.
All right.
Yeah. That's an oddity. I mean, I have found over and over again that homework is a positive, but not when it's viewed in a vacuum.
There is such a thing as overreacting or over-evaluating.
Well, I think that the actual line by line, if you parse the Lowe's conference call, you would be a seller of Lowe's, not a buyer. So you have to say to yourself, you can either say the buyers are all wrong, because the stock is up almost 15%, or you can say, what do they see? And I have always adopted the latter approach, because when I adopted the former approach, I became too inflexible, and I would bet against companies where the psychology had changed, and then have to come in and cover higher. There is something that intrigues all people of intelligence when it comes to the stock market, which is that they think that they know more than the market itself. And I am not that. I am humbled by the market. I don't like to be humiliated by it, though, and you will be humiliated, I think, if you don't understand what's going on with Lowe's.
All right. It's a good takeaway. Thanks a lot, Jim Cramer on Wall Street Confidential. Thanks for watching.